Hey, this is Mike, and for today's market strategy, I wanted to do a video that was actually suggested in the comment section. I thought was a great idea. Is kind of what to look for when picking a stock. So I want to take a look at sort of the 7 basic things that you want to look at when picking a stock. And these 7 things will probably give you a great sort of broad landscape view of a stock to decide whether you want to include it in your overall portfolio. So let's get started. So the first thing you want to look at is earnings growth. Now, earnings growth is basically you want to look at if a company is growing their earnings. What you want to do is you want to look at the current earnings or the latest earnings report and then compare that to last quarter's earnings and then the earnings from 12 months ago. So if you look at like the Q2 2020 earnings, you want to look at what happened in Q1 2020. So are they growing their earnings versus the last quarter and the versus Q2 of 2019 to see how they did during that same period 12 months ago. And a company with rising earnings is desirable. If a company has falling earnings, maybe they have a good reason for it. Maybe it was a supply chain issue, or just they're more of a cyclical company, so maybe it's a company that just does better in the summer than it does during the winter. But earnings growth is definitely, you want to look at a company that's just continuing to grow earnings. That pretty much tells you that that stock is more likely to move higher. So you can find the earnings growth just in the latest earnings report, and even just the latest press release on the earnings report, which you'll find on the investor relations page of any company homepage. Then you want to see how the company compares to the competition. Is the company a leader in its field? Who's the competition? Can the competition eat to the company's market share? Now, if you're a new investor, you always want to go with kind of the leader in an industry. So if you want to look at like a leading e-commerce company, then it's obviously Amazon. Now, maybe if you have a bit of an edge, maybe you want to look at a smaller e-commerce company, but you just go with Amazon. Amazon's the clear leader in its field. You look at retailers, Walmart, the clear leader in its field, and then maybe if you get a little more experience, maybe you find a more niche retailer that you want to invest in. Just kind of when you're starting out, find the company that really they're the leader, so they don't have any big competition. That's kind of the way I would start out, looking for a stock. Now, also you want to check if the debt to equity ratio is within the industry norm. So the debt to equity ratio is the ratio of liabilities a company has relative to its shareholder equity. So the liabilities are the loans, accounts payables, mortgages, warranties, bonds, deferred revenue, and accrued expenses. The shareholder equity is the value of the common shares, the preferred shares, and the retained earnings. So here's an example here. A company that has $3 billion in liabilities and has $2.5 billion in shareholder equity, the debt to equity ratio is 1.2. Now, usually you want to avoid a company that has more than double the liability to its shareholder equity or debt to equity ratio of over 2. So, for instance, if this company here had more than $5 billion in liability and only $2.5 billion in shareholder equity, that would be a little scary. They have so many liabilities that could be a threat to their stock. So look for debt to equity ratio of under 2. And that stock should be on your list of what you should consider buy. And then you want to look at the price to earnings or the PE ratio. So the PE ratio looks at how a stock's price is doing relative to the company's earnings. The lower the PE ratio, the better. So here's an example. If the company is trading at $40 a share and their earnings per share is 2.5, then the PE ratio is 16. Right now in this sort of high PE ratio environment, a PE ratio of under 35 is actually pretty good. If you see something with a PE ratio of 16, that's pretty much a value stock. That's something, I just did a video on AutoZone. AutoZone had a PE ratio of 17, so that's a really good PE ratio if you're looking for a value stock. Now, value stocks tend to not give you like these outsized return of speculative stocks, but if you're looking for something that's really safe and comfortable, look for a PE ratio of under 35 or a value stock PE ratio. Now, you also want to look at if a company pays dividends, its dividend performance. Now, a dividend is basically a payment made to shareholders every quarter or every year or every month. A company with rising dividends is a great company, but beware of companies that pay an unusually high dividend. If you see a company that's paying like a 10% dividend, you think, oh, great, I can make 10% a year. That company may be in big trouble and may not be able to pay its dividend. Maybe the dividend's real high because the stock price has fallen dramatically. Also look out for companies that are suspending dividend payments. Usually they're in trouble. They want to hold on to the money because they're having cash flow issues. If you want to find companies with good high-paying dividends, you want to look at REITs, energy companies. They all pay really high dividends. Also, utility companies, they pay dividends, usually safe dividends in the 5 to 6% range. These are good for like conservative investments. But like I said, this is really applicable if you're looking for a stock that pays a dividend. You just want to make sure that the dividend is safe and the dividend is rising over time. Also, you want to look at the company's leadership. Make sure the company has stable leadership. See if the company can recruit and keep top people. Sometimes you'll see a stock rise because they're able to recruit like a really good CFO or a really good CEO from another company. A company that keeps rotating CEOs is not a sign of a healthy company. So definitely check out the company's leadership. That's usually a sign of whether a company's doing really well or not. And finally, you want to look at the long-term strength and stability of the company. Where will the company be in 5 to 10 years? Can the company be disrupted? Like the hotels are being disrupted by Airbnb. Um, taxis are being disrupted by Uber. You just want to make sure that company can't be disrupted. And where will it be? This is what I try to think of what's a company could be valued at 10 years from now, especially speculative companies. And if I feel that that company has, because a speculative company, it could either go to zero or it could go up, you know, 10 to 20 times its current share price. So if I think a company 10 years from now, like a speculative company, is going to be worth 10 times what it is now, I figure, okay, I could lose 100% or make 1,000%. So it's worth putting 1 to 2% of my portfolio in a stock like that. Also, check out how the company can handle recessions or challenging economic times. Now, obviously, a speculative stock could get killed in a recession or challenging economic times. You have to consider that. But if you decide to buy a stock that has a low PE ratio, has rising earnings, they're going to handle recessions and challenging economic times really well. So you just have to be able to factor it in because over a 5 or 10 year period, over a 10-year period, there's pretty much a 100% chance that there's going to be a recession. A 5-year period, maybe a 25 to 50% chance there'll be a recession. So just have to consider how will this company, if it's a speculative stock, it may have trouble raising money during challenging economic times. So that's just one thing you want to keep in mind. So just to conclude, by knowing some basic information about a company, you'll be better able to make better individual stock purchases. So remember, I'm just going to recap quickly real here. Look at the earnings growth. Are they making more money over the past quarter, over the past 12 months? How does the company compare to the competition? Is the debt to equity ratio within industry norms? Usually look for a debt to equity ratio of under 2. Look at the price to earning ratios. Look for price to earning ratios in this environment now of under 35. Look at the company's dividends and its dividend performance. Look at the company's leadership, and finally look at the long-term strength and stability. So I hope this video is valuable. You may want to come back to it, just as a refresher if you ever try to figure out, okay, what should I look at when I'm buying a stock? I think these 7 areas is pretty much a pretty much nice worldview of how you can determine whether a stock is worth a purchase. So I hope you enjoyed this video. If you did, please be sure to leave a like and go ahead and subscribe and turn on notifications. I do multiple daily updates on stocks, stock trading strategies, and market updates. Thanks a lot. Bye.